Silver crashed 31% in a single day, the worst drop in 44 years. Gold plunged 12% from its all-time high. Mining stocks were decimated. Leveraged silver funds lost 62% of their value in hours. And according to COMEX delivery data, JP Morgan issued 633 delivery notices at the exact bottom, settling at $78.29 per ounce. Whether you call that coincidence or coordination, what happened on January 30th, 2026 changed nothing about the fundamentals. The supply deficit is still real, industrial demand is still growing, and the gap between paper price and physical reality just got wider. When you see what actually triggered this crash and why it's already recovering, you'll understand why this might have been the last chance to get silver under $90 an ounce. My name is Alex, and I've spent the last decade tracking commodity cycles and central bank policy so you don't have to. I read COMEX delivery reports, CME margin requirement filings, and Federal Reserve nomination announcements because most people have better things to do with their time. But when something like January 30th happens, when the largest single-day crash in 4 decades hits the precious metals market, someone needs to separate the conspiracy theories from the actual verifiable data. And that's what we're doing today. If you're serious about understanding commodity markets and you don't want to get caught in the next manufactured crash, make sure to hit that subscribe button and give this video a thumbs up. Before we dive in, I want to know, do you own any physical silver or are you trading paper? Drop it in the comments because I'm genuinely curious where this audience stands right now. Here's what I'm going to show you. The January 2026 silver crash wasn't random, it wasn't purely technical, and it definitely wasn't driven by fundamentals. It was a coordinated margin liquidation event triggered by a Fed chair nomination, executed through exchange rule changes, and amplified by algorithmic selling. And the same institutions that have been shorting silver for years closed their positions at the exact bottom while retail investors panicked. That's not a conspiracy theory, that's documented delivery data. And by the end of this video, you'll see why this crash might have been the final shakeout before silver goes somewhere nobody's prepared for. Let's start with what actually happened. The numbers are staggering. Silver hit an all-time high of $120 per ounce on January 29, 2026. 24 hours later, it settled at $78.53. That's a 31.4% drop in futures markets. Spot silver fell approximately 28%. Either way you measure it, this was the worst single-day decline since March 1980, when the Hunt Brothers Silver Corner collapsed and took the market down 80%. Gold didn't escape either. It dropped from a peak above $5,600 per ounce to $4,745, an 11.4% crash. Combined, the precious metals market lost an estimated $15 trillion in value in less than 48 hours. Mining stocks were obliterated. The VanEck Gold Miners ETF dropped 11.9%. Global X Silver Miners ETF fell 13.7%. Individual stocks were worse. Core Mining dropped 17%. Pan American Silver fell 20 to 25%. And if you were leveraged, the ProShares Ultra Silver ETF, which uses 2 times leverage, crashed 62%. 62% in one day. The iShares Silver Trust, the largest physically backed silver ETF, recorded its worst day ever, down 31%. Billions of dollars wiped out while investors watched helplessly. And here's the part that makes you stop and think. By February 4th, less than a week later, silver had already recovered to $89 per ounce. Gold rebounded to around $4,900 to $5,000. The crash was violent, but the recovery was almost as fast. That tells you something about whether this was driven by fundamentals or by forced liquidation. So what actually triggered it? On January 30th, 2026, President Trump nominated Kevin Warsh as the new Federal Reserve Chair. Kevin Warsh. Not a dove. Not someone the market expected. Warsh is widely viewed as hawkish on inflation, which means higher interest rates for longer. The market had priced in a dovish Fed pivot. Warsh's nomination reversed that narrative instantly. The US dollar surged approximately 0.8% on the news. That might not sound like much, but in currency markets, that's a massive move. And since precious metals are priced in dollars, a stronger dollar means weaker metal prices. It's mechanical. When the dollar goes up, gold and silver go down. But here's the thing, an 0.8% dollar move does not explain a 31% silver crash. It doesn't explain a 12% gold crash. The Warsh nomination was the match. The real accelerant was what happened next. The CME, the exchange that runs the COMEX futures market, raised margin requirements twice within 3 days. Let me explain what that means because this is where the mechanism gets brutal. When you trade futures, you don't pay the full price up front. You put up a margin deposit, usually around 10% of the contract value. That margin acts as collateral. If the market moves against you, the exchange can demand more money. If you don't have it, they force you to sell. In January 2026, the CME moved to a percentage-based margin system. Maintenance margins were hiked to 15% for standard positions, up to 16.5% for heightened risk accounts. Then, 3 days into the crash, they announced another round of hikes effective Monday, February 2nd. Gold margins went up 33%, silver went up 36%, platinum up 25%, palladium up 14%. Traders who were already underwater from the Warsh announcement now faced a choice: add more money to your account or get liquidated. Most couldn't add money, so they sold. And when everyone sells at once, the price collapses. This is the exact same playbook used in 1980 during the Hunt Brothers collapse. The exchange changed the rules mid-game. They implemented what they called Rule 7, which restricted buying and allowed only selling. Silver crashed 80%. The Hunts couldn't meet margin calls. Their positions were liquidated. Fortunes were transferred from leveraged longs to the shorts who stayed solvent. It happened again in 2011. Silver ran from $18 to $49 per ounce after the financial crisis. The CME raised margin requirements 5 times in 2 weeks. Silver crashed 48%. Retail got wiped out. Institutions closed shorts at the bottom. And it happened in miniature in December 2025. Silver hit a then record $84 per ounce during thin holiday trading. The CME raised margins twice. Silver crashed about 13%. It recovered within weeks because the fundamentals were still intact. January 2026 was the same pattern. Bigger scale. Same mechanism. What I'm about to show you next is the thing that took me years to fully understand, and it's the reason why these crashes keep happening at the exact moment retail investors are most exposed. Here's the part nobody talks about: the mining stocks. When silver crashed 31%, you'd expect mining stocks to crash proportionally, right? Maybe a bit more because of operational leverage. Pan American Silver fell 20 to 25%. Core Mining dropped 17%. Barrick Gold, one of the largest gold miners on the planet, fell 12 to 15%. Those are painful losses. But here's what's strange: silver miners only dropped 13.7% as measured by the SIL ETF. That's less than half the move in silver itself. Gold miners dropped 11.9% while gold fell 12%. Almost a 1-to-1 ratio. Why does that matter? Because it tells you the market didn't believe the crash was real. If traders thought silver was truly going back to $50 or that gold was heading to $3,000, mining stocks would have been obliterated. They would have fallen 50% or more. Instead, they fell proportionally less than the metals themselves. The market was pricing in a liquidation event, not a fundamental repricing, and the speed of the recovery proves it. Within 5 days, silver bounced back to $89. That's a 14% gain from the bottom. If the fundamentals had changed, that wouldn't happen. But here's where it gets really interesting. Let's talk about JP Morgan. Now, I need to be careful here because there's verifiable data and then there's speculation. Let me separate them clearly. Verifiable fact. JP Morgan has historically held large silver short positions on the COMEX. This is documented. They've been fined by regulators for spoofing and manipulation in precious metals markets. That's not conspiracy, that's core record. Verifiable fact. Reports from late 2025 indicated that JP Morgan shifted from net short to net long in physical silver. Multiple sources, including alternative financial media, reported that JPM accumulated approximately 750 million ounces of physical silver. If true, that would be the largest private silver stockpile in history. Verifiable fact. COMEX delivery notices show that JP Morgan issued all 633 delivery notices on January 30th at a settlement price of $78.29. That's the exact bottom. They delivered physical silver at the lowest price of the crash. Now here's what's unverifiable. Alternative sources claim JP Morgan closed $10 billion worth of short positions at the exact market bottom. The timing, the specific size of the position, the exact moment of closure. I cannot verify that because the CFTC does not disclose individual bank positions publicly. The Commitment of Traders report shows aggregated data by category, not by institution. So what can we say? We can say that JP Morgan issued delivery notices at the bottom. We can say they've historically been short and reportedly went long. We can say the timing is remarkable. Whether you call that smart trading or something else is up to you. But the pattern is there. And that pattern has repeated 3 times now in the last 46 years: 1980, 2011, 2026. Each time, margin hikes during a parabolic move. Each time, forced liquidation. Each time, the shorts close at the bottom and the longs get destroyed. If you've made it this far, you're already ahead of 90% of people who just see a price chart and think the bull market is over. But don't stop now, because what I'm about to show you is why this crash solved absolutely nothing. Let's talk about the supply deficit, because this is the part that should terrify anyone who thinks silver is going back to $20. 2025 was the 5th consecutive year of a silver supply deficit. The world used more silver than it mined. The Silver Institute, which publishes the official annual report, estimated the deficit at 95 million ounces for 2025. Other analysts put it as high as 200 million ounces depending on how you count recycling and above-ground stocks. Let's use the conservative number: 95 million ounces. Multiply that by 5 years, and you get a cumulative deficit of 475 million ounces since 2021. Some estimates put the 5-year cumulative deficit closer to 820 million ounces when you include unreported industrial consumption and the drawdown of exchange inventories. Global silver mine production is roughly 820 million ounces per year. It's been flat for a decade. It's not growing. In fact, it's declining slightly in some regions due to ore grade depletion and environmental restrictions. Global silver demand is between 1.1 and 1.2 billion ounces per year. Industrial demand alone accounts for more than half of that. Solar panels consume approximately 300 million ounces annually. Electric vehicles are approaching 90 million ounces per year by 2026. And now, AI data centers are rapidly increasing demand for silver in electronics and semiconductors. The math doesn't work. You cannot consume more of something than you produce every single year and expect the price to stay flat. But that's exactly what happened for most of the 2020s. Why? Because the paper market sets the price, not the physical market. And here's the part that should make you nervous. On January 1st, 2026, China implemented export restrictions on refined silver. China produces 60 to 70% of the world's refined silver. They didn't ban exports outright, but they added bureaucratic layers that slow the process and give the Chinese government veto power over any shipment. Silver is now on the United States critical minerals list as of 2025. That means the US government considers it essential to national security, and the largest supplier just put up barriers. The Shanghai physical silver market was trading at a $7 to $8 per ounce premium over COMEX paper prices during the crash. Let that sink in. While COMEX futures were showing $78, physical buyers in China were paying $85 to $86. The paper market said silver was crashing. The physical market said we'll pay whatever it takes to get metal. That's a disconnect. And disconnects don't last forever. Now here's the part that most people miss because they're focused on the price chart: the paper to physical ratio. There are estimates, and I stress these are estimates because exact numbers are proprietary, that the paper to physical ratio in silver markets is somewhere near 356 to 1. That means for every ounce of physical silver that actually exists in COMEX vaults, there are 356 paper claims on that same ounce. How does that work? Futures contracts, ETFs that don't hold full physical backing, unallocated accounts, synthetic products. All of it is layered on top of a relatively small physical base. As long as everyone doesn't ask for delivery at the same time, the system works. But if physical demand surges and paper holders start asking for metal, the system breaks. And when it breaks, the price doesn't go up 10% or 20%. It gaps. It jumps. Because there's no metal to deliver at the current price, the price has to rise until someone is willing to sell their physical. This is why the January crash didn't solve anything. The paper price dropped. The physical supply problem didn't. Industrial demand didn't stop. China didn't lift export restrictions. The deficit didn't magically turn into a surplus. All that happened was leveraged traders got liquidated and the people who understand the physical market kept buying. Now we're in the home stretch, and I need to show you why the fundamentals are not just intact, but actually accelerating. Let's talk about what's happening right now. As of early February 2026, silver is trading around $89 per ounce. It recovered more than 13% from the bottom in less than a week. Gold is back near $4,900 to $5,000. The Federal Reserve held rates at 3.5 to 3.75% at their January meeting. Markets are pricing in 2 rate cuts for 2026. Analysts at Saxo Bank are still targeting $6,000 per ounce for gold by the end of 2026. Citi forecasting $150 per ounce for silver within 3 months. Those targets were made before the crash, and they haven't been revised down. Why? Because the crash was technical, not fundamental. Here's what the crash actually did. It shook out weak hands. It liquidated over-leveraged positions. It allowed institutions with deep pockets to accumulate physical at lower prices. And it reminded retail investors that the paper market is not the same thing as the physical market. The real magic happens when you understand the psychology behind these moves. And that's what I want to talk about now, because if you don't get this part, you'll panic and sell at the bottom every single time. Markets are designed to separate you from your conviction. That's not hyperbole. That's the function. Volatility exists to punish the over-leveraged and reward the patient. Margin hikes exist to force liquidation at exactly the moment when the fundamentals are strongest, and crashes happen when the maximum number of retail investors are positioned for the move to continue. Think about it. Silver hit $120. That's an all-time high. Retail investors finally feel validated. They've been stacking physical for years. They've been mocked by financial advisors who say gold and silver are barbarous relics. And now, finally, they're right. Silver is rocketing. Gold is rocketing. They feel smart. And that's when the rug gets pulled. Because that's when they're most emotionally invested. That's when they're most likely to panic when the price collapses. And that's when institutions can buy back their shorts and cover their positions at a profit. This isn't unique to silver. It happens in every market. Real estate, stocks, bonds, crypto. The pattern is always the same. Price goes parabolic. Retail piles in. Institutions change the rules. Price crashes. Retail panics and sells. Institutions cover and go long. Price recovers. Retail misses the next move. The way you break this cycle is simple but psychologically difficult. You have to separate paper price from physical reality. If you own physical silver, the January crash didn't affect you unless you sold. Your ounces didn't disappear. Your stack didn't shrink. The paper price changed. That's it. If you were trading futures or leveraged ETFs, the crash destroyed you. That's the risk of leverage. You can be right about the direction and still get wiped out by volatility. This is why I'm a bigger fan of physical metal and unleveraged positions than I am of paper products. But here's the hard truth that might sting a little. If you panicked and sold physical silver at $80 because you thought it was going to $50, you didn't lose money because of the crash. You lost money because you didn't understand what you owned. Physical silver is a monetary asset, a commodity, and an industrial input all at once. It's not a momentum trade. It's a long-term hedge against currency debasement, supply chain fragility, and the financialization of everything. And when you see the price crash 31% in a day, you have to ask yourself a question. Did the fundamentals change or did the price change? Because those are two very different things. The fundamentals didn't change. The supply deficit is still real. Industrial demand is still growing. Central banks are still printing money. China still controls refining. The US still needs silver for defense and energy infrastructure. None of that changed on January 30th. What changed was the paper price. And the paper price is set by leveraged traders, algorithmic systems, and exchange rules that can be modified at will. The physical price is set by supply and demand. And the physical price never dropped to $78. It stayed elevated. Premiums over spot went up, not down. That's the tell. When physical premiums rise during a paper crash, it means the crash is artificial. It means the people who actually use the metal or who understand the market are buying, not selling. Now let me tie all of this together, because when you see how these pieces connect, the entire picture becomes clear. January 30th, 2026 was not the end of the silver bull market. It was a liquidation event inside a bull market. It was the same playbook that's been used 3 times in the last 46 years. Margin hikes during a parabolic move. Forced selling. Institutional covering. Retail panic. And then recovery. The difference this time is that the fundamentals are stronger than they were in 1980 or 2011. In 1980, the Hunt brothers were trying to corner the market artificially. That was always going to collapse. In 2011, silver ran because of post-financial crisis fear, but industrial demand was lower, and there was no supply deficit. Today, in 2026, you have a fifth consecutive year of supply deficits. You have China restricting exports. You have silver on the US critical minerals list. You have solar, electric vehicles, and AI data centers consuming more silver every year. You have central banks around the world still printing money and debasing currencies. And you have a growing awareness among retail investors that the paper market is manipulated. All of those things were true at $120 per ounce. And they're still true at $89 per ounce. The only thing that changed was the paper price and the number of leveraged traders in the market. If you were waiting for a pullback to buy silver, you got one. If you already owned physical, the crash was noise. If you sold at the bottom, you learned an expensive lesson about the difference between paper and physical. And if you're wondering what happens next, here's what I think. The recovery is already underway. Silver is back near $90. Gold is back near $5,000. The next move higher is going to be driven by physical demand, not by speculation. And when the next leg up happens, it's going to be harder to shake people out because they'll have seen this playbook before. The institutions that covered their shorts at $78 are now long. They're positioned for higher prices. The weak hands got liquidated. The strong hands accumulated. And the fundamentals are not just intact, they're accelerating. This was the last major shakeout before silver goes somewhere that's going to shock people. I don't know if that's $150 or $200 or higher, but I know the setup is there. And I know the crash on January 30th solved absolutely nothing about the underlying supply problem. Your future millionaire self is going to look back at January 2026 and see it for what it was. Not a collapse. A gift. A chance to buy physical metal at a discount while institutions were covering and retail was panicking. The question is, did you see it that way in the moment? Or did you let the paper price dictate your decisions? Silver, gold, commodities, monetary policy, what's the next topic you want me to dig into? Drop it in the comments because this is the kind of analysis that takes time and I want to make sure I'm covering what matters to you. The crash was violent. The recovery is happening. And the next move is going to separate the people who understand the difference between paper and physical from everyone else. Make sure you're on the